The market is already pricing in a Fed rate cut this coming week. Is this a mistake? And what does this mean for your treasuries? Hello, members, super savers, and bond course fans. I hope you're healthy and well. At the current time, the market expectation is that the Fed will lower rates by 25 basis points at this week's FOMC meeting on December 17th and 18th to a new target rate of between 4.25% and 4.5%. So, with that in mind, here are the three topics that we'll be covering in today's update video. 1. Is the anticipated Fed rate cut a mistake, and why? 2. Which treasuries rose and which ones fell this past week? And 3. What are the yield expectations for the upcoming 20-year T-bond and 5-year TIPS auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? In this section of today's video, we're going to dive a bit deeper into the 20-year T-bond and the 5-year TIPS auctions that are on the Treasury's calendar, as quite a few of you have requested. And as usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. As our Diamond NestEgg regulars know, we've been saying since 2023 that the downward path for inflation is unlikely to be a smooth one. And so far, this has proven to be correct. While inflation has come down significantly from its peak of 9.1% in June 2022, the latest inflation report from the Bureau of Labor Statistics shows that progress has basically gone into reverse in recent months. Consumer prices, as measured by the CPIU for all items, this blue line here, have actually increased again since their September low of 2.4%, hitting 2.7% year over year in November. And core inflation, this red line here, which excludes more volatile food and energy prices, has essentially stalled over the past several months, standing at an unchanged 3.3% year-over-year rate since September. Nonetheless, and despite inflation proving more persistent than expected, the CME Group sees the probability of a rate cut this week at 96% at the time of this taping. The general argument in the media at the moment is that a few bad inflation reports are not enough reason for the Fed to stop cutting rates. Never mind the fact that the November inflation report also showed the fastest month-over-month increase across nearly all consumer goods, excluding food and energy, in 18 months. And never mind the fact that there are some inflation worries around both the continuing strength of the U.S. economy, welcome as this is in principle, of course, as well as the potential trade and tariff policies under the new administration. And these 2 points also seem to be what's been driving longer-dated bond yields up this week, even as shorter-dated bond yields fell on rate cut expectations. So, long-term rates up, short-term rates down. And voila! The yield curve is finally uninverted on the extreme ends after more than 2 years. More on this shortly, but it does seem that the Fed and the markets are sending some conflicting signals right now. Personally, given the lack of progress on inflation and the recent reports around stable GDP growth, economic strength, and employment levels, I do fear that a rate cut this coming week could be a mistake and that it would make more sense for the Fed to keep rates where they are and continue their wait-and-see approach at the upcoming meeting, and for as long as it takes to see inflation fully under control again. That said, I also don't think this coming week is a make-or-break decision. The next FOMC meeting after this December one is scheduled for January 28th and 29th. So even if the Fed cuts rates this time around, they can always pause in January if inflation doesn't come down. The important thing at this point is that they don't take their eyes off the ball and allow inflation to spike again. And yes, if our economy continues to do well and inflation is not coming down or even continues to trend up again, this means that the Fed may even have to raise rates again at some point. In any case, and regardless of the Fed's rate decision this week, our expectation here at Diamond NestEgg is that 2025 will see another year of higher for longer rates at the long end, which, by the way, wouldn't be all bad news for the members, super savers, and bond course fans in our community who are planning to buy some treasuries with attractive long-term coupons. What do you think? Would a Fed rate cut this week be a big mistake or not? And why? How do you feel about inflation? Are you concerned about an inflation comeback? Drop a comment below and let the community know. And let's move on now to see which treasuries moved the most this past week. As we so often do at the end of the week, let's compare treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. Treasury yields fell on the short end on all T-bills from 1 month through to 6 months, as the market priced in the Fed's next rate cut. The biggest drops were seen in the 1 month, which was down by 14 basis points. On the medium and long end, Treasury yields all rose on the continuing strength of the U.S. economy, as well as inflation worries after the BLS reported the latest CPIU numbers, with the 20-year and 30-year spiking the most by a whopping 27 basis points. And as I mentioned earlier, the yield curve finally uninverted and turned positive again this past week on the extreme ends. The difference between the 1 month versus the 30-year now stands at a positive 18 basis points versus negative 23 basis points last week, meaning that at long last, investors are again getting paid at least a little bit more if they lend their money to the government for 30 years versus just a month. As a reminder, it was the other way around at the beginning of the year, when the 30-year paid 147 basis points less than the 1 month. And the widely used comparison of the 2-year versus the 10-year Treasury, which has been in positive territory for a bit now, has widened further, with the difference at plus 15 basis points this past week versus plus 5 basis points a week ago. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields across all maturities 2-year and below are noticeably lower than where they were at the start of the year. The 1, 2, and 3 month are now all down more than 110 basis points. The 3-year, on the other hand, is once again higher than where it started the year. Similarly, everything 5-year and longer continues to be above where it was on January 2nd of this year, with the 10-year up 45 basis points so far this year, the 20-year up 44 basis points, and the 30-year up even more at 53 basis points. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 19-year 11-month T-bond and the 4-year 10-month TIPS will be auctioned off as well this upcoming week. Both of these are reopening auctions, so we already know what the coupon will be on them. At the time of this taping, here's what the coupon and the expected yield are for the 19-year 11-month T-bond auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 4-year 10-month TIPS. Do keep in mind that these numbers can and usually do change all the way up to the time of the auction. For those of you who asked for a bit more detail on both of these auctions, here it comes as promised. The yield on the 20-year T-bond has trended up nicely since 2022, as you can see here. And as we covered earlier, it's currently 44 basis points higher than at the beginning of this year, and at a level that looks quite attractive if we compare the last 10 years. So, if the 20-year T-bond fits your timeline, goals, and expectations, this may be an auction to consider dollar cost averaging into. For the upcoming TIPS auction, this chart may be useful. Just like for the 20-year, yields on the 5-year TIPS remain at some of the highest levels when compared over a 10-year period. At the close of market this past Friday, the break-even inflation rate was 2.4%, which is quite a bit higher than the 10-year average of 1.92%, and slightly higher than the post-COVID average of 2.25%. But here again, if the 5-year TIPS fits your timeline, goals, and expectations, and you want to add some inflation protection because you believe that inflation over the next 5 years will average more than 2.4% annually, which at the current time seems not implausible in my mind, then this may be an auction to consider dollar cost averaging into. As I always say, everyone's financial journey is different. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one at 5.91% from Federal Home Loan Banks, with a first call date in June 2025 and a maturity date of December 2054. Here is the CUSIP for those of you who may be interested. For corporate bonds, the list is really short this week. Perhaps too much holiday eggnog. Here's where the highest yielding new issues stand at the moment, with the highest yielding one at 5.5% from Dow Chemical, with a first call date also in June 2025 and a maturity date of December 2054. Here's the CUSIP for those of you who may be interested. For brokered CDs, the yields continue to be as low as they have been in recent months, with the highest yielding ones from CFG Community Bank and Celtic Bank at 4.55%. The first call dates for the CFG CDs are in March 2025, and the first call date for the Celtic Bank CD is in June 2025. So, as I talked about in our recent weekly updates, we already have some exciting videos and plans that we will be sharing with you in the new year. As our channel has grown, we have gotten feedback on a wider range of topics that some of you want covered here. So, for those of you who may be interested, I've linked this Google form below again for you to give us even more detailed feedback on what you want us to focus on in 2025. The survey is completely anonymous, unless you personally wish to provide your email for us to follow up. While I cannot promise that we will be able to implement every suggestion you give us, do know that we will do our best to incorporate your ideas and suggestions. And I thank everyone in advance who will be completing the survey and contributing to all that we will do here at Diamond Nest Egg in 2025 and beyond for you. And of course, if you've already completed the survey, there's no need to do this again. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A on Thursday, December 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be diving deeper into this month's 2, 5, and 7-year T-note auctions and all things fixed income. This video is our last weekly update of the year before the Diamond Nest Egg team heads off to spend some holiday time with family and friends. That said, we do have one more special video in the works for you planned for next week. Stay tuned, as you won't want to miss that one. In any case, I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.